Ladies and gentlemen, good day and welcome to Samhi Hotels Limited Q3 and 9 months FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashish Jakhanwala, MD and CEO from Samhi Hotels Limited. Thank you, and over to you, sir.
Thank you so much. Good morning, and thank you for taking out time today. With me, I have Gyana Das, who's the EVP and Head of Investments, Rajat, who's Chief Financial Officer, and also Nakul, Vice President Investments. And along with my colleagues, we have Strategic Growth Advisors, who are also our Investor Relation Advisors. We have uploaded our presentation on the exchanges, and I hope everybody had an opportunity to go through the same. We're quite pleased to present to you the summary of the performance for Q3 FY24. Quick highlights. We have actually seen a very strong operational growth, with RevPARs improving by about 20.3% on a year-on-year basis. Very strong RevPAR growth and a full quarter impact of ACIC acquisition has led to a robust revenue growth of 39.5% and EBITDA growth of 51.4% on a year-on-year basis. We also crossed a strategic milestone in the last quarter for about 100 crores or 1 billion INR of EBITDA on a pre-ESOP basis. With the strong growth in revenue and EBITDA that we've seen in the last quarter, reduction in finance costs, we are seeing a rapid transformation both in terms of path to profitability and also free cash from the business. During the last quarter, which is Q3 FY24, we have seen our PBT almost reaching break-even, including considering impact of ESOP expenses, and this obviously sets a strong path towards near-term profits. Free cash from business was 460 million or 46 crores, and we continue to hold about 300 crores or 3 billion INR of cash. We expect some of this cash to be further used for reducing gross debt and reduce interest expenses. A very strong presence across price points, different brands, and being in key markets in India continues to be the driving force behind a strong performance and will be the lead indicator for our future growth. During the last calendar year, key cities in India have a total office absorption of about 40 million square feet. Our primary markets, such as Bangalore, Hyderabad, Pune, and NCR, which account for almost 67% of our inventory, benefited from a total absorption of about 30 million square feet of this 40 million square feet, or about 76% of India's absorption. Similarly, in the aviation sector, we've seen that it's reclaimed its pre-pandemic levels, and actually we remain fairly optimistic about a supply-led growth from here on, because this sector has really not seen a lot of growth from pre-pandemic levels, largely on account of supply limitations. Against a backdrop of very strong office and airline growth, we have seen RevPAR strengthen quarter on quarter, and as mentioned earlier, in the last quarter, it touched 20% growth over the previous year. Within segments, we've seen the upper upscale and upscale grow at a RevPAR of about 28% year on year. This portfolio contributes to about 43% of our revenues in that quarter. The broader mid-scale portfolio grew at a RevPAR of about 12% to 16% year on year. In addition to this, we continue to take steps for further improvement in the performance of our hotels and improving our market share. Asset income from hotels was at about 269 crores or 2.6 billion, a 40.5% growth over last year. However, within that, if you see the breakup, for the same store hotels, the growth was about 17.6%, and the additional benefit came from full integration of ACIC portfolio for the quarter. In terms of EBITDA, as I mentioned earlier, we achieved a strategic milestone of about 100 crores EBITDA for the quarter. The same store hotels saw an EBITDA growth of 27.8%, and then we had an impact of ACIC integration, taking the full EBITDA for the quarter to 1.08 billion or about 100 crores. As we integrate the ACIC portfolio into our business, we have new inventory addition coming in the current calendar year, ongoing renovations. We are fairly confident that this 100 crores of quarter EBITDA is just a great base for our earning trajectory. We cannot say that this is our best as yet, you know. In terms of operating margins, we have seen the portfolio has delivered an EBITDA margin of 40.3%. We expect this to improve as we stabilize the ACIC portfolio and also the hotels which are due for or are under renovation, where the margins have about 800 basis points scope of improvement. So as we get the whole of portfolio to converge where our same-store hotels are performing, we expect overall margins to also expand materially. One of the key insights from our business intelligence platform that we've highlighted in the current presentation is how the occupancies are trending on weekdays and weekends. The weekday occupancies across our entire portfolio remain fairly high in the range of almost 72 to 81%. And if you see on Tuesday, Wednesday, Thursday, the occupancies were range bound 78% to 81%. And this is for a 9-month period starting April to December 2023. While weekday occupancies remain strong and will remain strong because of demand supply, we actually expect the weekend occupancies to keep improving over a period of time with increase in discretionary spend and domestic travel. And I think that change will materially benefit how the income of hotels, especially in our portfolio, can benefit in the years to come. For all quarters, for the quarter, all three segments, which is upper upscale, the upper mid-scale and the mid-scale, saw very strong operating performance. We've seen upward trajectory in occupancy, RevPARs and ARRs when compared to the same quarter in the previous year. Given the strong performance of our portfolio, we are quite excited about accelerating our growth projects. As of today, we have an existing operating inventory of about 4,800 rooms, and we have already taken steps to increase it to about 5,400 rooms by FY27 at minimum. In the short term, our growth strategy involves integration of the ACIC portfolio, renovating and rebranding a substantial portion of our existing portfolio, and introducing new inventory. By September 2024, we expect to have about 180 rooms added, including our entry into the Calcutta market. We will have additional 130 rooms fully renovated and rebranded, and these 310 rooms make no or very little contribution to earnings as of last quarter or quarter 3 2024. Completing this inventory addition will provide a strong boost to our H2 performance in FY25, over and above the fact that we are seeing continued improvement in RevPAR in our same-store hotels. Also, in future, the proposed renovation at large hotels such as Hyatt Regency Pune will transform a large asset base and its contribution to our business. We can quite assure you that our time-tested strategy of conversion and turnaround is equally accretive when applied to our portfolio from time to time to create a differentiated outcome. With this, I will request Rajat to take you through a financial summary of the business.
Thanks, Ashish. Good morning. Let me take you through a quick walkthrough of our financials. With an asset income of rupees 2.6 billion, which is 40.5% above last year, we achieved an asset level EBITDA of rupees 1.08 billion, or a margin of 40.3%. Adjusting to corporate G&A, the total EBITDA prior to ESOP and one-time expenses is rupees 1 billion. This is a strong growth of 51.4% on a year-on-year basis. We have seen some material reduction in our finance cost. As of last quarter, the finance cost was 651 million or 65 crores, which has reduced materially from rupees 1.14 billion or 114 crores as of quarter 2 of financial year 24. With the reduction of gross debt and also cost of financing, we expect further reduction in the finance cost. PBT prior to exception item was negative rupees 60 million as against a loss of 803 million for the last year. We are almost breaking even at PBT level and are confident of turning positive in the near future. We would like to highlight that during January 2024, we have received a notice from Maharashtra Industrial Development Corporation, MIDC, regarding termination of lease of project land in Navi Mumbai. The asset is owned by our subsidiary, Do It Navi Mumbai, and it has filed a writ petition in High Court of Mumbai challenging the notice received from MIDC. For abundant caution, as an impairment for the value of land and related assets, Samhi has made full provisions during the quarter under exceptional items worth rupees 768 million. However, it is important to note that this asset is not projected to have any contribution to our revenues and EBITDA in the next 2 to 3 financial years. As of 31st of December, our net debt stands at 18.4 billion versus 29.4 billion in June 23, which was the pre-IPO debt. Our current cost of debt has now reduced to 10.2% versus the 13% which was prior to the IPO. Over the period, our leverage position is consistently improving, and as on December 31st, 2023, our net debt to EBITDA, including the ACIC for a full trailing 12 months period, is at 5.1 times. This will continue to improve as we have strong growth coming our way. Rapid reduction in debt and finance costs combined with increase in EBITDA is paving path towards reaching substantial debt levels and yet allow free cash for generation and for growth.
Thanks, Vijay. So I think in summary, our optimism and excitement comes when we actually layer a strong portfolio we've built, and in markets that you've seen very good office and aviation demand. We layer it with a very compelling market opportunity, and clearly the market is very strong for the hotel sector. We have an established track record of growth, and now we have increasing financial flexibility. So as I said earlier, while we have crossed the strategic milestone of 100 crore EBITDA for a quarter, we believe this is just a beginning and the best is yet to come. With this, I'd like to thank everyone for joining the call. We are here to address any questions, which can be obviously addressed on the call here or be redirected to us later or to strategic growth advisors. Thank you.
Thank you very much. We will now begin the question and answer session. To ask a question, please click on the raise hand icon tab available on your toolbar or on the QA tab available on your screen. You may also post your text questions on the ask a question tab available on your screen. Kindly turn on your mic when the operator announces your name. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Karan Khanna. Please go ahead.
Yeah, hi. Thanks for the opportunity. Am I audible?
Yes, Karan, you are.
Yeah. So, Ashish, just continuing on the discussion we had earlier this week also, how should one read the development in Navi Mumbai in terms of cancellation of the lease? What was the indemnification cover for the entire land parcel which got cancelled? And resultantly, earlier during the call, you also spoke about, you sounded quite confident about getting to a 5,500 room inventory by end of FY27. How should one read that in the context of the recent development at Navi Mumbai? So that's question number one.
Hi, Karan. Okay, Karan. So Navi Mumbai, we will tackle in 3 different parts actually. One is the accounting impact, the other is the legal case and the status and the remedies available to us. And third is actually its repercussions and impact on the business. Right? As far as accounting, we've taken the worst case scenario already in our books and no further risk is left exposed to the business, So we took the worst case scenario in our books in quarter 3. We've not really left any risk for any future impact of this or any consequence of this ongoing discussion with MIDC on a financial statements, right? So that's settled for all times. In terms of legal case, obviously, as you know, we feel very strongly about the actual position that we have vis-a-vis MIDC on this particular case. We have filed a writ petition. It is listed for hearing later in the week. I would refrain from commenting on that till such time the matter is not listed. As far as indemnities are concerned, we obviously, as any standard purchase agreement, we are reasonably protected in terms of indemnities we have from the sellers. Now, while the auditors have made a provision for about 10 crore in indemnity, in this particular case, the indemnity, in our opinion, may fall into fundamental reps and warranties, where the indemnity should provide us a cover for the full purchase price. So that's the second, legal, including any recourses available under contract, right? Now let's focus on the main issue, which is what is Navi Mumbai impact on the business. And I think we met a lot of you over the course of the last few months, and we kept stating that when it comes to a greenfield development asset in India, we actually always use it as a footnote information. We have not provided any forecast or guidance. Our only guidance was this hotel will open towards the end of FY27, right? Therefore, we were not estimating this hotel to bring any EBITDA or revenue to Samhi till FY27. Actually, it would only start from FY28. And therefore, for the foreseeable future, this asset has no impact on our business, except for the fact it would need about 2.4 billion INR or 240 crores of capital expenditure for it to be completed, right? Now let's model out the worst case scenario that our appeal in High Court and any subsequent appeals we may be entitled to do not get this asset to be protected. We actually are not very perturbed about that because, as I said, this asset came to us through a portfolio acquisition. We would have ideally not bought a greenfield site for development. We continue to track and negotiate some very interesting creative opportunities in the box that we are used to doing it, and which is not greenfield, which is brownfield acquisition, long leases, right? All of those opportunities bring revenue and EBITDA much faster than would a greenfield development. So if we were not to win our argument as far as this asset is concerned, we actually think we can redeploy that same 2.4 billion in assets which would bring revenue and EBITDA in an accelerated fashion rather than in a deferred fashion. Our confidence on 5,400 rooms is, I would say, certainty, because there is about 350 rooms which are lying in this bucket. The rest are lying in buckets which are under development right now. So replacing 350 rooms through a brownfield acquisition turnaround or a long lease is something we are tracking very, very well as of today. Hopefully in the next quarter or two, we should be able to confirm one or two opportunities. So as far as business is concerned, we see no impact of this particular development on our business.
Sure. This is useful, Ashish. Thanks. This is a follow-up. When we think about the acquisition opportunities that you'd like to pursue, in any segment that you'd focus on, whether it's upscale or mid-scale or upper upscale, or are you, any of these segments are fine with you? As long as what kind of IRRs would you be targeting?
So I think normally currently have a certain checklist. One of the checklists is that we should remain in key markets, which means that the 7 or 8 markets that we keep talking about where we see very good momentum of office and aviation demand. So we will like to maintain that discipline for now. Number 2, we will play the segments that we are good at, which is starting from mid-scale going to upscale, upper upscale. We don't intend violating that segment discipline as of now. The third, as I said, is we typically like assets which have near-term income, right? Which means that we're not necessarily looking at parcels of land for development. We're looking at either ready buildings or ready hotels where we can either complete it to a hotel or we can convert it to a good branded hotel. So that would be the checklist that we will follow. The pipeline that we have today, I can assure you it all confirms to that checklist that I've just mentioned. These are all opportunities in the top 7-8 cities. These are all opportunities that will eventually be positioned between mid-scale to upscale. And these are all opportunities where we will have access to income on a near-term basis, which would mean between 15 and 18 months, and not a greenfield development where it takes 3 to 4 years.
Sure.
And of course, IRR is important, but that is hygiene, Karan, so I won't talk much about it. Solving for a certain return on capital employed and doing it at below replacement cost is a hygiene that we've followed, will continue to follow.
Sure. And my last question on your net debt to EBITDA, what kind of guidance would you like to give on that front by FY25 and 26?
So I think for FY25, we've already given and we'll maintain that guidance of going to about 3.5 times. We are seeing a rapid reduction in debt to EBITDA every quarter. As Rajat mentioned, we are 5.1 times as of end of December. Don't forget, when we talk about 100 crore EBITDA number for quarter 3, there's a lot of more upside built into that because, that was the first quarter of ACIC. ACIC has gone into a Marriott managed portfolio from 1st February. It will go into a full Marriott managed portfolio probably sometime in first quarter of FY25. And that brings substantial impact on the contribution of that portfolio to our portfolio. 2, let's not forget the fact that about 310 rooms today are under very advanced stages of opening or rebranding. and that portfolio has had no impact of EBITDA in quarter three. So then you add the impact of that on our overall business and plus continued RevPAR growth in our existing business. So current fairly confident of maintaining a guidance of 3.5 times for towards the end of FY25 on a net debt to EBITDA.
Sure. This is helpful, Ashish. Thank you and all the best.
Thank you, sir.
Thank you. Our next question is from the line of Aditya Javed. Please go ahead.
Yeah.
Mr. Aditya, your line has been unmuted. Yes, please go ahead, sir.
Yeah. Thanks for the opportunity. Actually, I have a question on the business part, which is unclear. So pardon me for basic questions.
Sorry to interrupt.
So whenever
Your voice is breaking up. Mr. Aditya, can you hear me? Yes, sir. Now it is clear. Please go ahead, sir.
So my question is, whenever we buy out an asset, then we say that we operate it in the name of Marriott or some other party. So how does that work? So Marriott will have the management or we have the management there? So can you explain on this part? When you say operate, I'm a little unclear on this operation.
Okay, Aditya, so all of our hotels minus the ACIC portfolio are on management contract with the hotel companies. So under a management contract, day-to-day operations are outsourced under a contract to a Marriott or an IHG or a Hyatt, and we retain obviously all the asset management rights in that asset. So ACIC portfolio today is franchise, which means it is being managed by us, and over a course of time, we actually intend for that also to be under a management contract, where the day-to-day operations will be managed by Marriott for those hotels.
Okay. So what do they charge, sir, for us if we give the management contract to them?
So Aditya will take you through our P&L and so that you can see the exact. So if you see in the last quarter, the total cost towards management fee was 4.9% of our revenues.
Okay. So basically, we have two kinds of portfolio. One is managed and one is franchise. And we tend to move to from franchise to again manage. So that is our focus totally.
That's right, Aditya.
That's right. Okay. And in terms of when you say take time for operation, so suppose in Kolkata we have bought in some of the keys, right? So how much time does it take to renovate and then operate, then give it to management contract?
So with respect to Calcutta, it's a hotel that is yet to be completed, so it's not a renovation. I put that slide on the screen right now. The building is ready. It is in fit outs at this stage as we speak, and this hotel is scheduled to open by September of 2024. In terms of conversion, this is one example that you're talking about. So in Greater Noida, this hotel has been operating under our own transition brand called Caspia Pro. This hotel is currently under renovation, and we started the renovation somewhere in mid-January, and we expect also this hotel to be open before September 2024. And this is 137 rooms. So this is a example of rebranding, renovation and rebranding, and the prior slide is more for a brownfield being complete for an operating hotel, which is Calcutta.
Great. Sir, and if you could, it's just a request, if you could publish ROC of some particular area. You know that some are very old and some are very new, right? That would give a great sense that when operating leverage or that will kick in. So that is just a request from my end.
Sure, as the point noted, we'll try and provide some ROC analysis in subsequent quarters, both by maturity of assets, and we also feel sometimes it's important to look at ROC of different cities. Because each city is in a certain rate track. For instance, Bangalore, we believe, is doing really well on the average room rates. Our early calculations show that our assets in Bangalore would be delivering a ROC of somewhere in the early to mid-20s, right? So that's a very healthy ROC. And then it will be followed by markets like Hyderabad, which are also now rapidly growing and improving. So we have that analysis ready, but I don't want to present inadequately prepared information, point noted, you will see some analysis of ROCE in the subsequent quarters.
Great, sir. Thank you. All the best. If I want to connect, I can connect to SGA and the management team, right? If I want to understand better.
You're more than welcome. You're more than welcome.
Thanks. All the best, sir. Yeah.
Thank you.
Thank you. Our next question is from the line of Nihal Jham. Please go ahead, sir.
Hi, good morning. Am I audible?
Yes, Nihal.
Yes. Thank you so much, Ashish, and congratulations on the performance. I just had one observation and question that when I look at the RevPAR performance for your upper upscale and the other category, there is a decent divergence in terms of how we've seen that. I think it's 20% plus for one, and it's close to 12 and 16 for the others. So is this a location-specific issue, or is it that this is the divergence you're seeing across categories where the premium segment is having better pricing power versus the mid-scale segment?
So Nihal, a couple of points there. One is that last year, the upper upscale hotels are still ramping up in quarter three. Now, if you look at what differentiates these segments, they're more or less in the same cities. To some extent, the upper mid-scale has assets in, let's say, Coimbatore, right, which will drag the performance down because we've always believed that the tier one is really outperforming all other city categories. So there is some impact of mid-scale and upper mid-scale being in tier two cities like Nashik, Vizag, Coimbatore, so on and so forth. But also, let's remember the fact that upper upscale assets which have a higher dependence on international business travel, right? They had a lower base last year, Nihal, right? Because the international business travel was recovering every quarter last year. This year, we've seen reasonable recovery in that. So some bit of a base effect also has kind of allowed the upscale to shine vis-a-vis the last year. And the second, as I said, is the reason that our upscale is concentrated in tier one. Our mid-scale and upper mid-scale have some sprinkling of Nashik, Coimbatore, Goas and Vizag, where we've really not seen as good a growth as we've seen in the big cities. We'll next time try and give you this analysis by city, and you'll be able to really clearly see as to how is the city impact, not just a segment impact actually.
Sure. Just one clarification here was that for the recovery of international travel, you mentioned that also became a driver for the upper upscale segment in terms of the better performance.
Yeah, sorry, didn't get
International travel.
International travel.
It's a catalyst for the...
Yeah. International travel has been growing as a proportion of overall room nights sold. It is still marginally lower than where it used to be on a pre-pandemic level, but it is definitely higher than where it was same quarter last year. Right. So I think that is one factor when it comes to upscale performance. Now, upscale typically we are about 35%, international business travel, 35-36%.
Sure. And just one more question. Sure, go ahead.
Yes.
Is the portfolio or is the current pipeline that you have of, say, rooms that you identified cognizant on what the outcome for the new Navi Mumbai litigation is, that 5,400 is the target, or that is an independent assessment that will happen and we could actually end up increasing that room count also depending on the opportunity being accretive, and say even if the Navi Mumbai litigation goes in our favor, just to understand that.
Yeah, so I think, we didn't start pursuing growth, we had no idea of the Navi Mumbai development. Actually, up until December end, MIDC was giving us all requisite approvals, including a fire NOC. And then suddenly in January, we got this bit of a disappointing surprise. That's why we've gone to the courts. So therefore, whatever we've been doing has not been dependent on the outcome of Navi Mumbai. It's actually driven by how we are confident about creating a reasonable financial flexibility in our balance sheet for growth, right? So if you look at, Rajat talked about how, on a trailing 12-month basis, if you see, which means that we're including the full ACIC portfolio's EBITDA, right? We have achieved about 358 odd crores of TTM EBITDA against an annualized interest cost as of today of about 200 odd crores, right? So if you see there's a flex of 158 crores, even if we assume zero growth, which in my opinion is going to be a bit too pessimistic an assumption, right? So with the growth coming our way in our existing portfolio, plus the fact for very little capital